9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne with Annabelle Droulers.
We're coming down to the open of markets in Greater China, and our top stories this morning. Asian stocks edging higher as oil prices retreat. US and Israeli leaders seeking to calm concerns over the Iran war. Israel saying it will heed President Trump's call to end attacks on energy infrastructure.
But bond yields are surging as traders bet that elevated energy costs will lead to rate hikes, even as the ECB and BOE follow the Fed in keeping lending costs on hold.
And Alibaba shares set to fall in Hong Kong after a nearly 70% plunge in quarterly profit, piling more pressure for its massive AI spending to pay off.
We start with some breaking news when it comes to the loan prime rates in China. No surprise here is unchanged at the moment. I think given the fact that, after MPC, we were expecting some sort of rate cut and then maybe the loan prime rate would follow. But we didn't quite see that. Inflation relatively looking better in China as well. So maybe they're pushing off that when it comes to cutting these loan prime rates for now. But I can't wrap my head around just the price action we've seen, Belle, in the last 24 hours, whether what we saw in the gilts markets, German bunds and the like, as we start pricing in a more hawkish central banks around the world around this Iran situation.
Yeah, I think that's sort of the key takeaway from all of these meetings this week is you've got steady rates, but it's not so steady in terms of the outlook because it's just been that continual messaging we're hearing from central bank makers or policy makers that they're just trying to grapple essentially with where the Middle East conflict goes, how extended it is. And you're seeing those gyrations also coming through in the bond market volatility as well, because it's just unusually elevated. And not to mention, of course, Alibaba and the numbers we've had on that front as well.
Yeah, so adding to the bad news, right, when you're talking about a 67% plunge in quarterly earnings here, it just goes to show why they're doubling down or even quintupling down when it comes to what their projections for AI are going to be when it comes to revenue, just to offset what's going on when it comes to food delivery and, of course, e-commerce and the like.
Yeah, I mean, there was sort of not a lot of good news really coming out of the numbers. Not only do you have that big spend on AI, but you're also really feeling the pinch on the e-commerce front as well and trying to spend to defend market
spend
share.
To defend, I like that.
Yeah, well, there we go. You're welcome. All right, let's take a quick look at the market action as well, because as we said, it's that big focus on what's happening in the commodity space, and certainly these messaging that you're getting from the Israeli US leaders as well around they're not going to be attacking essential energy infrastructure, essentially trying to calm down the markets. And you've seen that reflected because we have seen Brent crude WTI pulling back, even though, of course, you've got to put in the context what has been a major rally in these since the start of the conflict. Gold as well, I mean, trading fairly steady, but it has been pulling back essentially for the past several sessions. Let's take a look, as we said, bond market activity. We do have Japan shut today, so we don't have cash treasuries right now, but we are just keeping a watch on what's happening with yields. Really, the front end of the curve is in pricing this prospect of higher rates from here. But again, as we said, investors or policymakers still trying to grapple with where the conflict heads from here. Commodities or FX rather, I should note, we did see the dollar slumping again. It was after we had the ECB, BOE, BOJ as well, just really highlighting the risk of inflation. So you saw that pullback in the dollar steadying this morning, but taking a look at how equities are trading as well in Asia today, because we actually are just seeing them moving modestly higher here, mostly across the board. Of course, Australia to the downside, but we are just seeing some modest gains, as I said, being led there by the likes of the Kospi you can see over in Korea. So TSMC, one stock to watch, and should just mention this is a bit of a different story, but we do have local media in Taiwan essentially reporting that TSMC and actually Samsung as well have raised prices for the sub 5 nanometer nodes, so they're more advanced technology. Just again goes into their essentially tighter capacity and a lot of pricing power on that front. And as we said, China, just taking a quick look at what we're expecting ahead of the open today, but that big focus really on Alibaba. You're looking at the ADRs there, but a sharp plunge overnight.
Yeah, certainly that'll be that might damper some of the, I guess, optimism around stocks here this morning as we start to see this, signs of maybe possible de-escalation when it comes to the Iran side of things. Let's bring in our news desk managing editor Jill Deesa. She joins us now. So you heard from the Israeli side of things. You heard from Trump as well, both trying to really tamper down what's been going on in oil prices and the like too.
Yes, that's right, Yvonne. Well, I think, when you're looking just over the last couple of days at how much things had really escalated, I mean, those Israeli strikes essentially prompting an incredibly aggressive response from Iran over the past couple of days. I mean, that strike on that liquefied natural gas field in Qatar, I think Qatar Energy has said that cost them about $20 billion in revenue over the next year. I mean, we are looking at massive, massive implications for the global energy markets with some of these strikes. So, there's certainly that acknowledgement now when you're looking at what Trump has said over the past couple of days, what we've heard from Netanyahu earlier, that attempt to sort of de-escalate some of that rhetoric, because again, Iran has shown that, they're like, look, if you come for us, we'll come for you. I mean, you've got, there's really massive strikes. You're seeing on your screen just how far that's really sort of stretched over that entire region. So certainly, those attempts to reassure investors seem to be working, at least for the moment, but we'll have to see if that actually turns into some kind of a, long-running de-escalation in this conflict.
It's been fascinating, and probably not a time essentially that the Japanese Prime Minister may have hoped to have travelled to Washington, just given the pressure that Trump has been putting on allies. But it came up as well, even a reference to Pearl Harbor in that conversation or that meeting you had with her. But just take a listen to this first.
When we went in very hard, and we didn't tell anybody about it because we wanted surprise. Who knows better about surprise than Japan? Okay? Why didn't you tell me about Pearl Harbor? Okay? Right? He's asking me, no, you believe in surprise, I think, much more so than us.
I mean, that's quite remarkable, really, and certainly, I mean, we're calling it a cavalier attitude, but just talk us through how that would have been perceived and the significance of that.
Yeah, what a wild clip. I mean, see the look on Takaichi's face there, just lips pursed, like absolutely trying not to react in that moment. We had actually heard, from other officials that, Japan was expecting quite a few, sort of off the cuff things from Trump, but, not really that. I mean, look, like this is a really, really difficult to manage relationship. And obviously for Takaichi, really difficult for her to come into this because, while the Japan is an important ally for the United States, it's pretty laid out in their constitution to not get involved in these types of global conflicts, and would be enormously unpopular at home were Takaichi to get involved to that level. You did have them kind of like going back and forth over Trump saying, well, Japan is a strong ally, they're helping us out, and like NATO, but it's kind of unclear exactly what he's talking about there. So I'm not really sure that we got too far ahead of, into the sort of specifics of what exactly it is that he's, getting from Japan here. But at the very least, I think, for Takaichi, the importance of this visit is sort of to reaffirm the relationship, things that they can commit to each other on in terms of, economic targets and things like that. But obviously, she does not want to get involved in this war.
You know what I find so exceptional about that as well is that Pearl Harbor is considered one of the most significant intelligence failures in US military history. And then this week as well, you've had the head of the counterterrorism, one of the most senior counterterrorism officials in the US resigning, and a lot of questions again around how intelligence is being used in this conflict as well. So I found it fascinating, that comment.
Yeah, Jill, I mean, obviously there's going to be a lot about what came out, but you could definitely feel the tension, as you said, Jill. Jill Jesus there, our news desk managing editor, on the latest when it comes to Iran. Another story that we're tracking, as we talked about, is, of course, those Alibaba earnings. It looks like we could be bracing for a bit of a sell-off here today, indicated lower here in Hong Kong after that 67% plunge in third quarter profit and little revenue growth. And that's really piling pressure on its pivot to AI and cloud as a major driver of the earnings.
Yeah, let's get more on this now, bringing our China correspondent Min Min Lo. So Min Min, just talk us through it. This is obviously not numbers that maybe they wanted to showcase, just given the push they're making into AI, but it does seem like it's going to take a while to pay off.
Yeah, I mean, it's a pretty ugly set of numbers. We're talking about 1.7% gain in revenue versus estimates of 3.4%, so half of that. A net income sliding by 67%. That is also far below estimates. And the big driver of this decline is really in its e-commerce business. And e-commerce traditionally is the biggest cash cow for Alibaba. It makes up 70% of revenue in third quarter. And this is where Alibaba would take the money to go invest in AI. But this time it's getting badly hit because last year the company entered the quick commerce business. That means they have to deliver goods within under an hour. So they've spent a lot on promotion, spent a lot on logistics, and they're going through this fierce battle with Meituan. And their promotional spending went up by over 60%. It makes up a quarter of their revenue now. So that's the big hit. And even that, when that whole segment comes down, it really is not enough to offset the improvement on the AI side. And the outlook remains challenged because when you look at the macro backdrop, the government has lowered the growth target. We're not sure whether the price war is really behind us. Will we see another bubble tea war this summer again? So a lot of question about that. And the company said that they are looking at fiscal 2029 as the year when the quick commerce segment would turn profitable.
Wow. Okay. So yeah, still quite a ways to go. This week as well, the big story for Alibaba has been around the organizational restructuring to really try and focus on that monetization of AI. But what are we seeing in terms of the revenue side so far?
So the cloud computing business is still pretty solid. We're looking at 36% growth on year. That is slightly ahead of estimates. But again, the company has set a very high bar for itself because it's targeting 100 billion yuan in revenue in the next 5 years. And to get there, they need to maintain this around 35% gain pace of growth over the next 5 years consistently. And I think analysts are taking that with a pinch of salt. If you look at the forecast now, and these forecasts sometimes are not very accurate so far into the future, but analysts are now expecting 70 billion yuan as their revenue in the next 5 years. So still quite a big gap there. And of course, there's still that turmoil around the restructuring, the key engineer leaving as well. So a lot of question around how that AI division, how healthy it is really.
Min Min, thanks so much for joining us. That was our China correspondent, Min Min Lo, there. And we're going to have more on Alibaba and China's overall AI push later this hour. We've got Macquarie Capital's Ellie Jiang joining us, and she's actually saying that the establishment of that Alibaba token hub should be viewed as a milestone for the business. We'll have more on that ahead, and we're counting down, of course, the open of trade in Shanghai, Shenzhen, Hong Kong, where we are seeing Alibaba looking like it's going to open lower as well. But we'll have more ahead. This is The China Show.
This is a very volatile situation. I think by the next time we meet, which will be, our next decision is at the end of April, a lot will have happened, and I can't predict none of us can predict what it will be. But it is a very volatile situation. So I would caution really against getting ahead of that position, which is we held this time.
The risks to the inflation outlook are tilted to the upside, especially in the near term. A prolonged war in the Middle East could lead to a larger and longer-lasting upward shift in energy prices than currently expected, raising euro area inflation further.
That was the Bank of England Governor Andrew Bailey and ECB President Christine Lagarde on whether they see inflation risks from the ongoing war in Ukraine. Let's take a quick look on how markets are faring. We are heading 15 minutes away from the open session today. Of course, Alibaba is going to be the one stock to track, but generally, actually, we are seeing equities just moving a bit higher.
Yeah, I mean, thanks to, of course, the easing of oil prices, right? We were talking about getting closer to 120 just, a few hours ago, yesterday, and then now we're easing back to slightly above 100, thanks to what we've heard from the Israelis, what we heard from President Trump in trying to calm these sort of markets. But then again, when you take a look at what's going on in the rates markets, and that certainly seems like there's been a shift, right? When you talk about what's been priced in right now in markets when it comes to the BOE, they're pricing in maybe possibly 3 25 basis point hikes by the end of this year. ECB as well, pricing almost 2.5 hikes after those meetings that we got and what we heard from Bailey as well as Christine Lagarde. Let's talk a bit more about what this all means, the implications for markets with Benjamin Deng, President of Asia Asset Management at Sun Life. Benjamin, it's good to have you here on the program. Do you feel like things have shifted in any way, given what we've been hearing from central banks about how they're responding to this energy shock?
I think from historical perspective, this is still staying within the normal range. So far, there are blips on the market, blips in geopolitically. But over the long time, this is not as crazy as before, like 20 years ago, and we've seen many other things, way, way, way bigger. So we remain our close to neutral allocation at this moment. Yeah.
I guess the message we've got from a lot of central bankers this week is more around the uncertainty and not knowing how, and for many investors as well, how long this is going to be extending for. But it sounds like you're actually working on a shorter time horizon.
For me, we look at a very long-term investment horizon. So if we look at next 10...
for the end of the war, essentially, that you...
Yeah, so far, I think the scale is still relatively contained. Hasn't gone out of control yet, I think. And so that's why we remain pretty calm with our allocation strategies, watching at any moment if things turn upside, we will be ready to move in. Yeah.
You sound pretty sanguine about it, but when I talk about oil prices where trading ranges could be $10 to $15 in a given day, what does that tell you about positioning in this market here right now?
You look at the inflation rate, it's still not reflecting what we experienced back in the 1980s. So, comparatively, I think the whole world is watching, but I think we are still in the normal range. And again,
so what are you doing in terms of your exposure? Have you done anything? You said you kept a neutral equity allocation even before this Iran situation.
We slightly went on the cautious side, a little bit, close to neutral, but we remain very agile. Just be ready to go in anytime. Yeah.
And what would be the opportunities that you'd look for? What would spark your interest, do you think?
Oh, a peace talk, a de-escalation of the situation, and a opening up of the trade routes, everything.
I mean, in terms of the assets that you'd look to...
Oh, equity has to be equity, and we're very much... I'm managing the Asian market, Asian business, as the management business here, so it's our Asian equity allocation, of course, yeah.
What about commodities? Are you looking to add any exposure to oil, to some of the precious metal space, given the situation?
Base metal, precious metal, are the two, broadly speaking, materials, is one sector we've been overweighting consistently. And I think that's not a temporary thing, it's a structural thing in the next 20 years. Yeah.
In terms of sectors that you like in the equity market, we've seen still tech continuing to push higher even with all of this angst around Iran. What's your take on that sector?
Oh, tech is another sector we overweight in our portfolio. It's again, we're in the era of tech-driven, AI-driven, data-driven productivity enhancement. So it's not just about frontline technology companies, it's a whole ecosystem, value chain, all the way up to the material, raw material, which we are all very bullish on. Yeah.
I know you manage, the insurer's money and MPF here right now. Just tell us a little bit more about how you're managing for external parties versus your own sort of insurance invested assets right now.
Not structurally different, not fundamentally different. The performance measurement could be different. Insurance is a very long-term business. Yeah. Pension, we do have certain mechanism in the pension market to compare to the peers and to pitch to our customers more frequently and more directly. But fundamentally, it's a long-term money, and we just want to communicate with our customers and make sure we all are on a long-term investment horizon basis. And just don't be bothered by 1 day or 2 days blips in the market,
In terms of insurance invested assets that you manage for your parent group, can you tell us how much you have exactly in that space?
Well, it's part of our global portfolio. What I can disclose is what we have disclosed publicly, 1.6 trillion AUM for entire Sun Life group. We're the number within the top 25 asset managers globally. But in Asia, we've been here in Hong Kong for more than 130 years. It's a pretty solid business, and we've been through a lot of turbulences in history. And that's why you can see we're kind of calm at this moment.
Yeah. If it wasn't for this Iran situation, I think one of our top stories would be what's going on in private credit right now, whether the cracks that are forming. I know you also have exposure to alternative assets in North America.
We do.
How are you viewing the whole concerns around private credit now? With
private credit, we're primarily North American driven. We have huge capacity in origination in this space. Investment strategy, my take is diversification and stay long term. Don't have knee-jerk reactions. That's very important. And the sector, private credit, is still growing. It's not in a bubbly situation by now. It's just an extension or different format of a loan business. But loan book globally is gigantic. And private credit is still very small in the very early stage. Again, coming back to risk management, be diversified is very
Are you
important.
cutting your exposure at all
No,
in the space?
we're not.
Okay.
We're not. Yeah, we're actually very steadily allocating into this space. Yeah.
Benjamin, thanks so much for joining us.
You.
That's Benjamin Deng there, President of Asia Asset Management at Sun Life. And just taking a look at how Alibaba's faring, because we've just had pre-market trading coming online and we are seeing a significant drop, but not really surprising in the context of what we saw in ADRs overnight. But the headlines, of course, from the earnings result is that, yes, they're targeting $100 billion of AI revenue in 5 years, but certainly pressure in the near term in terms of still time for ROI or for investments into AI to pay off, and also a lot of spending and pressure in the e-commerce side.
Yeah, even when it came to that 36% increase in the cloud unit growth, that still failed to satisfy a lot of what investors were expecting as well, given that the vision that they've unveiled here to really expand heavily into this whole AI and cloud sales to over $100 billion in 5 years, right? How are they going to get there? I think they were not too clear in terms of the vision there during that call. So certainly we'll continue to watch this one, how this affects, of course, other tech plays, whether it's agentic AI, whether it is the e-commerce and food delivery space here. When it comes to futures, we're still flat here this morning, but Hang Seng is lower by 0.6%. Plenty more ahead. This is Bloomberg. Alibaba is going to be the name of the game here today. Take a look at how China tech is going to perform. Well, it looks like we're seeing a decent sell-off here when it comes to the stock. We're down some 6.5% or so. Price targets have been slashed a little bit from the sell side here today, but certainly it has been, of course, the disappointing earnings that we got. Sluggish growth in e-commerce, weak domestic consumption, and like really intensifying that competition in the food delivery space really did cut into their profits. Xiaomi could be interesting too, but we are actually seeing it as the number 2 biggest drag on HS Tech. Number 1, of course, has been Alibaba. They did unveil this updated version of their SUV, or the SU7 sedan, I should say. So launched at competitive pricing as well, despite these rising costs. So that's one thing to watch. And Delton Tech, we do have a listing debut in Hong Kong here today. Obviously, it could be an interesting day given the volatility we've been seeing, but it seems like it could be a good first day of school for Delton Tech. We're up 32% for the stock. Of course, we're tracking, of course, not just the tech space, but, it really has been the miners that certainly have been, I guess, given the whipsaw we've seen in aluminum. We talked about the biggest drop yesterday in the LME since 2022. Copper has erased the gains for the year as well. So we'll have more coming up in the open there next. This is Bloomberg.
Welcome back. You're watching the China Show this morning, taking a look ahead of the market open. I think really the broad narrative for markets today is around investors that are getting a little bit more optimistic about ships that may be able to pass through the Strait of Hormuz. You've seen oil pulling back, equities moving slightly higher off the back of that. But Hang Seng, you can see indicated lower, and that is very much, I think, the Alibaba story here. Yeah, I mean, we were talking about waking up to the reality that central banks are getting more hawkish, particularly the ones in Europe, right? When you heard from the BOE, you heard from the ECB, front-end rates are basically telling you a message that is that, they are going to continue to be hawkish here, and certainly that could roil the whole equity space. But then again, now that we have kind of emerged away from the cliff when it comes to where oil prices are, we're inching back closer to 100 than 120 over the course of 24 hours. I think that has helped in some way in terms of sentiment. But as you say, Alibaba could be the dampener for Hong Kong today. But on
onshore market is looking a little bit better in the face of that. We're up 0.5%. Shanghai Composite is pretty much flat around that 4,000 level. Key to watch when it comes to some of these massive reversals that we're seeing when it comes to aluminum, copper. I mean, aluminum was at the beginning of this whole Iran situation was seen as one of those beneficiaries given the supply disruptions. Now you have metal traders now pricing in the possibility of what this could do to the global economy in terms of the growth picture. And you're seeing massive moves in the LME contracts here when it comes to aluminum, copper, basically erasing gains for this year. Aluminum had the biggest drop yesterday. I think trading volumes were at records yesterday in the LME electronic platform. So there you go. You're seeing that following here in some of these China futures there. Aluminum futures are down some 2%. Shanghai crude is also lower by 7% here. So the commodity space is easing off just a bit here. Certainly that does help equities in general. You're seeing when it comes to that CGB curve, not much change really, but that steepener trade certainly has been a trend of late, but we're not quite following what we're seeing when it comes to fixed income across the world here this morning as well. Large caps are mostly doing okay on the onshore space. Let's flip the boards and look at what we're seeing in Hong Kong, because that's where you might be seeing more of the price action, and you are seeing more negativity when it comes to the tech space. There you go. Alibaba's down some 5%. We're watching the rest of the e-commerce, rest of the food delivery space. JD.com is also falling as well, given maybe those earnings results from Alibaba did show how intense this competition is right now when it comes to e-commerce and food delivery. But interestingly enough, Meituan is actually up some 2%. Tencent is doing better after the slump we saw yesterday after their earnings as well. So certainly there's a lot of concerns around the reducing the buybacks in order to fund for this whole AI capital spend. That certainly did worry the market just a bit. Xiaomi, on the flip side of this, they also just launched this new model of this new sedan. But yes, the shares are heading lower by about 4% here this morning. So it's mostly lower when it comes to the tech space here today. We're watching very closely the Hang Seng here. We're lower by about 1% right now. Not much, moderate, but the rest of the region is actually doing better, so to speak. Offshore RMB, we're at 688. Keep in mind those LPRs were unchanged this morning as well. It really has been the industrial metals. It's the precious metals space where we've seen a lot of volatility, right? So we talked about when it comes to gold prices, silver prices, which were actually falling in the face of this kind of rate hike expectations around the ECB and BOE. That has seemed to have eased in the Asian session a little bit here. Copper and aluminum and the LME contracts are actually doing a little bit better, coming off some of the initial moves that we've seen. So certainly there is a bit of that. We'll see how these miners play out here. So when it comes to precious metals, miners there, copper miners, mostly higher here this morning. Keep in mind, Zijin Mining, China Hongqiao also reporting results later on today.
Yeah, and it is that big results focus because, as we said, Alibaba is the stock to watch essentially in the session today following its own numbers. But Macquarie is actually keeping its outperform rating for Alibaba despite the drop in those numbers. So the bank cut its price target for the stock to 171 Hong Kong dollars from 216. Joining us now is Ellie Jiang. She's head of Asia Internet and Media Research at Macquarie Capital. So thanks very much for coming into the studio.
Thank you so much.
Let's talk about that change to the price target and your overall reaction to the numbers. What drove it essentially?
Yeah, I think we're at the very interesting times when, if you compare this year versus last year, the sentiment has been shifting. That last year, investors were very much chasing the momentum of AI, trying to, gauge the news stories driven by this AI boom. But of course, this year is almost that reality check when the earnings are kicking in. People start to realize, okay, we need to really evaluate the investment returns and the ROICs, on all of those cash deployed. So I would say yesterday was almost kind of a demonstration of, seeing that this conflicting market sentiment that people were trying to balance out this pretty sluggish core earnings, as well as for their still pretty strong cloud momentum. For our side, we did the target price because to reflect the more aggressive investments on the e-commerce and those foundation model front. But we still do believe, Baba is probably the best one to be positioned into this AI front, especially with their pretty unique full stack capabilities on the AI infrastructure. Eventually, if you look at the AI investment wave, right, what's being more tangible is really the capex, that the hardware side that's really seeing really strong pricing power. That you are seeing all of those rising tokens, the usage, all bringing into much higher need for compute. So we do think Baba is really unique on that front.
I mean, it's a high bar then, really, for their AI endeavors, given the weakness that we're seeing when it comes to the e-commerce space. They're talking about quintupling. I haven't seen that in an earnings report in a while. Quintupling cloud and AI revenue to $100 billion annually in 5 years. That's about, 30-some% growth a year? Do you think that's actually feasible? Is it reasonable? How will they get there?
Yeah, so they're basically implying roughly 40% CAGR in the next 4 or 5 years, right, on the AI cloud revenue, and mostly for external revenue. I would say at the current juncture, it seems to be a very ambitious target. But just judging on the current token consumption, especially with the fact that now more and more developers, even casual users, are using these agentic tools and products to try out and really experimenting into their life and work experiences, it does seem like the token surge will just continue. So we're actually seeing that accelerated usage of AI could be further boosting the cloud usage. So I say for the near term, it does seem like the cloud revenue will be climbing on this upward revenue momentum.
Yeah, I found it notable as well, just given the market sort of punished Tencent early this week for not having sort of defined targets in place around monetization, and then maybe Alibaba, then it's the concern they're being a little bit too optimistic. But the story as well this week was the reformulation or reorganization around this Alibaba token hub. How significant do you think that restructuring is?
I actually think this is a very important milestone for Baba. Eventually, if you look back into all these large companies' histories, right, they previously have been very concentrating on their core businesses. For Tencent, it's advertising, gaming. For Baba, it's e-commerce, right? But now we're clearly shifting into this new regime. So into the new regime, you have to really reposition based on the current kind of capex spendings and all the resources that are needed for these AI investments. Before, Baba was very much focusing on just on the cloud infra side, but clearly all these Q and app as well as for the agentic OpenClaw, these are driving the next wave of the more kind of prosumer facing usage. So I think it's the right thing for them to kind of pull all the resources together and try to visualize it from a token usage perspective. I think eventually that is the direction we're going into the next agentic era.
I mean, it seems like there's a lot of changes with OpenClaw and this, embracing of lobsters in China, and some have argued, some investors that, and people on the sell side, that Tencent, just given that it has this whole WeChat ecosystem, has this initial advantage, maybe even over the likes of Alibaba, given the fact that they have this massive data trove and massive user base and the like. How true is that narrative here? And overall, just how do you think that reshapes the overall competitive space when it comes to OpenAI and agentic AI in China now?
Right. I think to be extremely honest, we're at the very, very early stage of adopting, regardless of OpenClaw or some other agentic products down the road, right? So ultimately, it's too early to call for the winner. The way I would look at the problem is that we should actually think from a few components. Number one is whether you have the channel, whether you have the actual data usage, and that would not just talk about the casual user traffic, but it's also developers who are using these tools constantly. Right? These are all intelligence and data. So I think these would be the key things, and of course, AI infra again kicks into the equation as well. If you kind of benchmark on that scale, I would say Baba and Tencent equally would have the chance of winning per se. But judging by the current setup, it does seem like Tencent is kind of taking the lead on the front end, which is more ecosystem, consumer usage, their enterprise solutions and so on. And for Baba, it seems like they're having a better advantage on the back end, which is more infra related.
You said you recently had a bit of a workshop with investors on OpenClaw and all these kind of agentic apps that are out there right now. What was the overall take? What were some of the questions that you've been asked?
Well, I guess the most fun and most asked questions was how much have I spent on training my OpenClaw. But clearly, I think there are a huge amount of interest, right? For especially for investors, obviously, we are kind of constantly juggling with, which product to try on and whether we're running into this big security risks and so on.
Sure.
So we're still at the stage where people are just exploring different options. But it does seem like this is I kind of visualize OpenClaw as a symbolic event to indicate that we are kind of going into the next stage, right? Eventually, I don't see OpenClaw as a standalone event or a product. I actually see it just as kind of a mirroring product to indicate, this is the trajectory of the industry developments. Overnight, we're seeing, Cloud Code is also developing, pushing for some agentic features as well. That just indicate, right? Eventually, all of these developers, professional enterprises, users will all be incorporating more and more of these autonomous agents into our work and life experiences. That basically will be a huge read across for the token hubs, right? Token usages down the road.
What do you think then in terms of, because you're making it sort of clear you think Alibaba, Tencent is sort of the best positioned here, but what about then the AI startups, and of course you've got Jipu and Minimax that have recently listed, but there's Moonshot, there's Step Fund, there's more of these names. Given how commoditized this technology is becoming, what do you then make of that huge run-up we've seen, and maybe more led by the retail side, but how sustainable is it, do you think?
Yeah, well, to start with, I wouldn't say that technology is commoditized just yet. I think yesterday Baba's management was making it quite clear that you got to have, the infra, you got to have basically the actual token. So it's more driven by, your actual architecture as well as for the models, right? So everyone's got different models, and of course these models are now evolving to be more adaptive to agents. So eventually that is still kind of the kick. Now, we are seeing how a lot of companies are becoming token factories per se, right? So ultimately, if you use that phase, then what we need to see next is who produces tokens at a more cost-efficient scale and who are better positioned to face the prosumers or consumers, from a more mass market kind of usage. So I think that is still kind of the key decision factor. So I wouldn't necessarily draw a clear cut between the large internet platforms versus the frontier labs. I think eventually everyone's got their own position. And since we're just at the very early stage of industry adoption, I think everyone's going to just see this massive integration of agents into, the broader workspace. It's more about frontier labs or the overall agents taking over the traditional internet usage.
Just quickly then, because the other story as well was Alibaba raising the price of some of its cloud services
by 30-some%.
Yeah, exactly. So how significant is that then in terms of trying to monetize and essentially get that ROI?
Yeah, I think the initial trigger of that price tick was really just the price hikes from the infrastructure side, right? We've seen memories, we've seen CPUs all raising their prices. So I think it is a pass-through of the cost. But at the same time, it also is the demonstration that they do have very strong pricing power, right? Especially in the China market. If you look at the overall public cloud services providers, Baba clearly has very strong leadership. They are the largest, CSP in China, and that kind of makes them at a much better position when it comes to the price adjustments and potentially paving a better path for monetization down the road.
I was going to get your take on the Tencent earnings as well. It seems like there was, some say, a lack of a clear pivot to AI. Is that a fair assessment overall, and why the market reacted the way that it did?
I think what happened was, kind of joining back to Tencent's DNA, right? It's been very much towards kind of a consumer-facing ecosystems, and that it has been a key advantage for Tencent. But when it comes to agentic era, the methodology we've been using is we call this framework. It's a 3-level traffic order. Basically, what it means is you're basically having the traditional workflows of the parallel internet usage now into a 3-level pyramid, right? So autonomous agents, generalist agents will be on top of a funnel, and then they will be able to recognize your intention and delegate into specific vertical solutions. And on that note, I would say, Tencent is now into a new phase where they have to either find the new native app or they have to revamp WeChat itself, right? With then coupled with a lot more aggressive investments approach as before. So they're kind of in a transitional stage, if you will.
Okay, Ellie, thank you. Ellie Jiang there, head of Asia Internet and Media Research at Macquarie Capital. Let us know the next time you host these open claw workshops.
Yvonne's ready. Yvonne's ready.
We have to do it on TV. We're ready with her hats, Ellie. Anytime we need it. We need a bit of a course. We need to know.
Yours looks so cute on you. It's like a little beret.
I put on the good jacket too to match it.
I know you thought about this.
We're continuing on the trend. Ellie, it's great to have you. We look ridiculous, but yes, we're going to take these off now. Ellie Jiang, head of Asia Internet and Media Research at Macquarie Capital. Let me fix my hair. You still look good, though.
No, I don't.
Look at how Asian markets are doing as we go to this break right now. We're seeing better markets here when it comes to onshore. We're up about 0.7%. When it comes to China, Shenzhen is looking pretty good. We're up some 2% here right now. We got plenty more to come. This is Bloomberg.
In some corporate news this morning, FedEx shares rose in late trading. That's after the company raised its full-year profit forecast, signaling that a plan to restructure its delivery network is gaining traction. Investors are looking to FedEx to gauge the impacts of the Iran war and the Supreme Court's decision against many of President Trump's tariffs. The company says it doesn't expect the war to have a direct material effect on its business. Bloomberg's learned that Kalshi, that's the largest prediction market platform in the US, has raised more than $1 billion in a new financing round. Sources say the funding, which is led by Coatue Management, will roughly double Kalshi's valuation to around $22 billion. The prediction market is facing questions from some US lawmakers about vulnerability to insider trading and manipulation.
Well, we're checking New World Stock, as you just saw there, what's going on in Hong Kong. Well, we're slightly to the upside here, but we've been talking, and what our sources have been telling us is that the billionaire Cheng family is betting on the revival of the city's property market to meet its debt obligations. Sources say the embattled developer is now mulling options, including a public share sale, rather than giving up control to investors. For more on this, let's bring in our China credit reporter, Trista Xingyi Luo. She was part of this story. Tell us a little more why the Cheng family is kind of resisting outside investors now.
Yeah, so first of all, they don't want to give up their control of New World. And then I think, we recall that by the end of late last year, the Chen family has been really eager to secure outside capital. They have been in talks with Blackstone to actually in discussion for a deal which will let Blackstone to take control of the company. But right now, they're betting the turnaround of Hong Kong's property market. The housing prices are projected to up maybe around, 15% this year. And for the mall rents also up 5%. So this kind of positive sentiment give the family some confidence to explore other options, as we mentioned about the around $4 billion public share sales plan, and that's one of the leading option the family are exploring right now. And that plan, which maybe they will give it to some designated investor, or will dedicated to all shareholders in a pro rata basis, which means that the Chen family, which now holding about 45% in New World, will contribute about $1.8 billion.
Yeah, it's really been quite exceptional, the twists and turns in the saga of this and all of the different talks, and now, of course, benefiting from what could be a revival of the property market. But is the company actually out of the woods, or is there still more pressure to come, do you think?
Well, definitely there's still some pressure there, right? We need to remember that New World is actually carry over, $27 billion in liability. So that's still there. But I think what's let us know is that the imminent pressures for New World is not that high, but we need to record that the mega refinancing, they sealed the deal like last year. That's $11 billion deals, which it will come to mature in 2028. So analysts are telling us New World still have more, maybe around a year, and trying to improve their financial structure.
All right, Trista, thanks so much for joining us. That was our Bloomberg reporter, Trista Xingyi Luo, joining us there. And you can get an insider's guide to the money, the people as well that are shaking up the finance hub in our Hong Kong edition newsletter that's out every Thursday. You can sign up by scanning the QR code on your screen or via bloomberg.com/newsletters. More ahead. This is Bloomberg.
In some world news this morning, sources have told Bloomberg that President Trump and top Justice Department officials support a new bid to investigate Fed Chair Jay Powell. Last week, a judge rejected subpoenas issued to the central bank, which prompted U.S. Attorney Jeanine Pirro to say she would appeal the decision. The investigation is related to the Fed's $2.5 billion renovation of its headquarters and testimony Powell gave to the Senate. Wall Street lending giants could get relaxed capital requirements under proposals unveiled by the Federal Reserve. The changes could potentially unleash billions of dollars for lending, share buybacks, and dividends. The plans are subject to a 90-day public consultation, but if approved, will represent a major win for the industry. President Trump says he is resetting his planned trip to China, suggesting it could now happen in mid-May. Trump was due to head to China at the end of this month, but decided to delay the trip as he focuses on his war with Iran. His planned meeting with President Xi Jinping will be closely watched for progress on trade and Beijing's reaction to the Middle East conflict.
Taking a look at Xiaomi shares as well this morning because it's just unveiled an updated version of its EV car that's with new hardware and safety features as well. So this was anticipated. It's been a big week for Xiaomi with different unveilings around the autos, but also the AI space. The SU7 sedan is going to start at just under $32,000. That's just under 2% more than the first generation version. The updates also include redesigned door handles with external mechanical releases rather, and that is of course in line with the new safety rules in China.
Yeah, analysts are projecting, at least UBS, 100,000 pre-orders in the first week of sales for this SU7. But yeah, I think it's just a matter of, I guess, buying the rumor, selling the fact. I think the shares have rallied some 9% this week already on this debut alone. So sentiment was already pretty up, I guess you could say, given with the whole AI story as well. So certainly Xiaomi is selling off here just a bit here. Watching the rest of the EV space, obviously, as well. Just given what we've been talking about, right? This whole Iran situation, does it just kind of force China to electrify everything? And I think we're seeing that, given this whole, there was a great story that Linda Liu wrote about the BYD showrooms that are basically popping up in the face of this whole Iran conflict. So certainly the BYD stock has been actually up for most of the few sessions here this week as well. We're up another 0.7%. It's a mixed bag across some of the EV names, though. XPeng does come out with earnings a little bit later on, though those shares are down about 3% here. But the rest of the tech space has been dragged down. It is really the Alibaba story here. That's why you're seeing HS Tech down and sub 5,000 here right now, mind you. 5% losses for Alibaba right now, and that is now bringing down even Meituan, which was actually earlier up.
Yeah, exactly. Taking a look as well, just a quick check on Samsonite, Li-Ning and GM. We are just seeing some mixed moves here, but you've got those earnings for Samsonite really undershooting. You can see that's, of course, being reflected in the drag there. China dashboard, just taking a look at those benchmarks because, again, it's a bit of divergence. You've got onshore is actually outpacing what we're seeing the losses for the Hang Seng in the morning so far. More ahead.
Welcome back to the China Show. A look into the HSI half hour into the session, and kind of like those clouds, it was looking a little bit gloomy here in Hong Kong as we wrap up what has been yet again another volatile trading week here when it comes to the price dynamics we're seeing around oil. We are inching away back to $100 here after we got close to 120 just about 24 hours ago, and so certainly sentiment has improved overall, but then again still a lack of clarity on really what the objectives of the U.S. and Israel are when it comes to the Iran situation. They have, at least calmed down oil markets. I think, when it comes to the rates markets, that's where, the front end is certainly seeing a lot of those concerns here on just how hawkish central banks really have to be to fight this energy spike.
Yeah, hawkish holds, you could say, I guess we've seen this week, and a lot of policymakers just flagging the uncertainty, essentially. I think for investors, or equity investors at least, it's sort of which one do you listen to more? What you're hearing from world leaders around the Strait of Hormuz, oil passage again, or you focused on what policymakers are saying and the risk to inflation moving to the upside, essentially. But let's take a look at how markets are faring so far, because we are just half an hour into the session as well for onshore, and you are just seeing, again, improving sentiment here, which reflects what we've got mostly across the board in the session so far today. Japan, of course, is shut for a public holiday, but we are looking at fairly flat for the broader gauge. Some upside, though, in certain sectors. Korea, of course, standing out because you've heard the likes of TSMC, Samsung raising the price of their more advanced chip architecture. Let's take a look, as we said, big focus on what's happening in the yield space. We've seen at the front end of the curve, at least, some expectations that we are going to see rate rises, possibly. We heard from the likes of the BOE, for instance. I mean, again, as we said, a hawkish hold, but signaling it's ready to act. We had the BOJ as well, holding its target rate, but a lot of references to the Middle East situation. ECB, we're hearing from sources that are familiar with the matter that they could be ready to raise rates as soon as their next meeting. So that is certainly being priced in, even though as well you see again these comments that we get around oil and from Trump. We get it from Netanyahu saying that we're not going to have any more attacks on critical energy infrastructure. That is what's been playing into oil prices. But taking a look at what's happening across the commodity space, because gold, silver, they have been really under pressure, essentially, with these risks on the inflation being flagged.
Yeah, and I think you start to see, right, the possibility of rate hikes being put on the table when it comes to the BOE. I think, as you talked about, our sources saying, the ECB could act as soon as next month. Markets are pricing about a 63% probability of that in the April 30th meeting. B of E is also about a 50%. So it's a coin toss here right now around that meeting that comes next too. So what you're seeing across, industrial metals, precious metals, at least now they're all gaining, but really there has been a sharp reversal in industrial metals, just given the potential growth shocks this could have on the global economy and the like. And it really has started with what happened in the rates market, right? This fresh volatility in bond markets as investors rush to bet on higher interest rates with the surge in oil prices threatening to reignite inflation. Let's get more now with Ruth Carson, our chief correspondent for FX and rates in Asia. Ruth, it seems like a pretty sharp pivot when it comes to expectations after we heard from the ECB and the BOE. How hawkish were they?
They were very hawkish. And in fact, traders in Asia are waking up and going, wow, look at those massive moves, particularly in the front end, in the UK. And also the messaging, it's about fighting inflation. There is a deep-seated fear now in markets that this war could be prolonged. I mean, who knows when it will actually end, even though, we are hearing some messages about, nerves being soothed. But the thing is, if we look at where commodity prices are, oil is still very elevated compared to where we were 3 weeks ago. And the question on traders' minds at the moment on the macro side is, how long can markets sustain these price pressures? They will feed into day-to-day lives of people. And as a result, central banks will more likely have to act than not. It's a bit of a game of nerves at the moment, but absolutely fighting inflation, hawkish central bank commentary, that's on investors' minds at the moment.
How long then does it persist, and what exactly do you think activities are going to look like even going into next week?
I think if we look at markets today, how long is a piece of string is probably the answer to that, because we woke up, we saw Australia, New Zealand bonds reacting as well, and their gauges in this part of the world when it comes to sentiment. Again, the moves in the front end, 10 basis points and more, it kind of shows that investors are going, we're still not comfortable, with where inflation is headed. We're not comfortable with what we're seeing, despite, some reassurances on the political side on tensions. So sell bonds. Even gold and all that are not the havens they are, supposed to be. And it probably will persist going into next week as well.
It's times like this, Ruth, when I need to start asking questions, and I think, should I ask AI? Is that something that's a good source of info here in the face of all this uncertainty? I mean, you've been tracking this story about traders really using this to help in the face of all this volatility.
Absolutely. And I think we're definitely not alone here in seeking answers. Traders absolutely are on the same boat. So we spoke to a bunch of investors from Singapore to Tokyo to New York to Sao Paulo about whether or not they're using AI and how they're using AI to map out the risks from the Iran conflict. And the short answer is yes. A resounding yes. Everyone is turning to Claude, to Gemini, to ChatGPT, and really being mindful of the prompts that they put in. What does it mean for oil? Map out for me 5 scenarios. Should tensions continue going on for months? What does it mean for inflation? What does it mean for central bank rates pricing? What does it mean for monetary policy paths? All these questions are being fed into LLMs, and they are helping. But whether or not it's accurate really depends on the fact checks that come after it, and that is what traders are stressing right now. AI is not the answer, but it's a very, very powerful tool to help in the investment processes.
Ruth, it's a really great story, and certainly one that is amongst the most read on the terminal this morning as well. So it just tells you, really, I guess a lot of people are also looking for perhaps tips on how they can also get in on the action. But that was Bloomberg's Ruth Carson there, as we said, her story. Traders overwhelmed by Iran news are turning to AI for help is really gaining a lot of traction this morning. But we should shift now as well, because, of course, a lot of what is driving that volatility, or what is driving the volatility, is essentially what's happening in the Middle East. And to that that end, we've heard from the leaders of the US and Israel as well, trying to reassure markets that are rattled by damage to the major Persian Gulf energy facilities. Meanwhile, just moments ago, we heard from the UAE Defense Ministry saying it's responding to incoming missile and drone attacks from Iran. Our news desk editor, or managing editor rather, Jill Deesis joins us now. So, yeah, bring us up to speed then on the latest now.
Yes, I think at this point, what you're really just seeing out of at least the U.S. and Israel is that reassurance that those energy sites aren't going to be targeted. This, of course, after that barrage of attacks from Iran responding to attacks from Israel this week, where we saw massive disruption. I think really the key piece of that being that strike on that Qatar liquefied natural gas field, world's largest, as we've been discussing, something where, Qatar was saying that's $20 billion worth of revenue lost over the course of this year. Really, really sort of substantial shocks to the energy markets globally. So you do have those reassurances where, obviously, we're still waiting for more details out of these latest lines from the UAE. But, perhaps that's more of a pivot towards something that's a military strike rather than something that's targeting critical energy supplies. So we've got sort of that de-escalation in place. But again, I really just want to emphasize that at this point, we still have no idea when this war will end. I think we've gotten fairly conflicting reports over what exactly it is that the U.S. versus Israel wants out of Iran. Israel pushing for regime change. The U.S. obviously has made that nuclear program a focal point, but still, the way that Trump talks, it's sometimes really difficult to sort of nail down the clarity in terms of what, a complete objective would ultimately look like. So we don't really have a full sense of how long exactly this could continue to go on for.
Yeah, you mentioned about Netanyahu saying they're not going to target energy assets. Do you have any indication if Iran's going to follow up and say, look, we'll also kind of hamper down and just, de-escalate from on their side too?
We'll see, right?
Yeah.
I mean, again, I think that the big issue when you're dealing with a conflict like this is it's incredibly volatile. And obviously, you do continue to see some of these strikes traded back and forth. Obviously, what we saw with that Israeli attack on South Pars, that energy situation in Iran, was what predicated these really aggressive attacks earlier this week. So, maybe there's sort of that de-escalation on all sides here. But again, because we're dealing with an active war, it's so difficult to tell what exactly this ultimately looks like, whether we'd need to go through the steps of actually formalizing some kind of a truce. It's just still a very, very volatile situation and really difficult to tell exactly how things are going to progress. But obviously, as of right now, you are seeing a little bit of that de-escalation of tensions.
Yeah, but as you said, from the perspective of President Trump, really just difficult to ascertain what exactly the end objective is, and as well how clued in allies were to the actions that he was prepared to take. And we heard, of course, the Japanese Prime Minister Takaichi in Washington for a meeting with Trump, but this came up as well as that reference, of course, to Pearl Harbor. But take a listen.
When we go in, we went in very hard, and we didn't tell anybody about it because we wanted surprise. Who knows better about surprise than Japan? Okay? Why didn't you tell me about Pearl Harbor? Okay? Right? He's asking me, do you believe in surprise? I think much more so than us.
So that's obviously...
you can see her face.
Yeah.
She's pursing her lips. She's looking at her team, really trying not to say anything. But overall, what did Takaichi really achieve?
Really, really tricky trip for Takaichi. Obviously, you've got incredibly stunning statements like that coming out of the U.S. president. What she's ultimately there to do is she can't, just volunteer Japan for getting involved in an active conflict. I mean, I think that's against decades of, sort of constitutional mandates out of Japan.
Pacifist constitution.
Exactly. Obviously, incredibly unpopular at home. What she was able to do was just sort of, pledge some other forms of support, saying that Japan is committed to, buying more U.S. oil. So, there are some elements there that, she's willing to do, but obviously a really, really tricky line to walk for Takaichi. And I think really speaks to the fact that, you've got also Trump kind of equivocating here a little bit, saying, they want Japan's help. Japan's more helpful than NATO, although he didn't exactly specify what he meant by that, but at the same time, he's also saying, oh, well, we don't need, their help anyway, kind of a thing. So it's like you see a lot of sort of contradictory statements coming out of Trump. I think for Takaichi, she accomplished what she needed to accomplish, which essentially just come in, maintain the relationship. This is obviously a very critical U.S. ally here, but, she just isn't available to get involved in an active conflict like this.
Yeah. And meeting before, I guess that meeting with President Xi, too, for Trump, that might be quite telling in terms of the timing as well. Jill, thank you. Our managing news desk, managing editor Jill Deese is there on the latest when it comes to Iran.
All right, up next as well, we're going to get back to Chinese equities. UBS Global Wealth Management is joining us. They actually see Beijing's focus on tech innovation and consumption as a positive. We'll get the details with Ellie just ahead. This is Bloomberg.
In my view, the best market to own, equity market to own in the world during such a period is the Chinese mainland market. China is light years away ahead of the US in terms of energy, and energy is probably the key sector globally.
That was Jefferies Global Head of Equity Strategy, Christopher Wood, speaking with us yesterday. And just taking a look at how Chinese benchmarks are faring this morning in the session. We're a bit under pressure, and that's really being led by the Hong Kong story, which again comes back down to the Alibaba story. And we had those numbers out yesterday after the session. Lots of concerns really around yes, a very ambitious plan around monetization of AI, but at the same time, the spending that takes and the pressure that they're feeling in their e-commerce business as well. So that is sort of the broad picture for Chinese equities, but you can see that onshore actually is doing a bit better and sort of also just taking its cues, I guess, from what we see in markets in other parts of the world.
Yeah, I think it just goes to show what Chris Wood said yesterday to Hazard Insight, which was basically onshore stocks have been quite resilient to all the headlines when it comes to Iran. Our next guest maintains an attractive view on Chinese equities. Let's get more now with Ellie, head of Greater China Equities at UBS Global Wealth Management. Eva, it's great to have you. So Chris Wood was saying the best equity market to own right now is onshore mainland, just because of how insulated it is. You know, China has unlimited access to cheap power. How much do you kind of hold to that view?
Well, I think this has been the case. If you look back in the past crisis, China A share, or even actually China H share, has been resilient if you compare to the correction that we are seeing in the other markets. But in fact, if we sort of look back in Asia, what's the component? There are a lot of value stocks. So the mix is due to the value versus growth. And so obviously with the worry about rates, whether we really will still have rate cut or we will have rate hike, you know, that of course it will hit growth area. So that's why in a way, and plus, you know, Asia benefited from banks. They're going to announce results, but I believe that the dividend will still be the sort of the focus. They will deliver that sort of 30% paid out ratio, dividend yield still attractive. And we are seeing a major deposit migration. Because 3 years ago, a lot of money is not going to property market. They go into the deposit, fixed deposit for 3 years. Now maturing. We expect even if like less than 10% of this maturing deposit go into the system, investing into equity or other trust product, we are talking about 2 to 4 trillion renminbi.
Yes, so I guess that's the cash pile that we often talk about that's being sat on. So what's the upside potential then that you see for onshore equities?
Well, have to say they already have, sort of outperformed. So we're talking about high single digits, sort of low teens upside. Relatively, we're still seeing, the Asia market is resilient. H share, has been affected by the outside world, the de-risking, the internet results, a bit of mix.
What's your take on the earnings from the tech side so far? I think it's been disappointing overall.
Yes, but in fact, if you sort of hear what management said, the worst case, or we are already seen, sort of worse in terms of earnings, in terms of operations. They did try to, sort of give investors, focusing more on the AI growth story. The margin is going to be better. The strong demand for cloud, but the market needs to digest. And obviously, no matter of US or China, always when the result disappoint, no matter how much the share price have corrected, they will correct more. So, result surprise would just be muted. But negative, any of the disappointments, market will react very, drastically.
You still think that you should broaden the exposure to tech? right now. How so?
Continuing. We actually downgrade U.S. tech from attractive to neutral. That was before the Middle East crisis. We consider particular the U.S. hyperscaler. In terms of the future AI, the investment is likely to moderate. They already invest up to the full free cash flow in total. And we should be looking into power and resources. That actually is an AI infrastructure that has been doing very well, despite that, obviously, I mean, the overall U.S. equities have been a bit of rebound because people consider it's a bit of a safe haven. But overall, we see potential growth, better valuation is actually in power resources, industrial, these are the sectors that we favor.
What about the consumption story as well? How are you thinking about that this year?
I mean, in terms of China consumptions, in the first 2 months, it's sort of better than people expect in terms of growth. If you look at the results, I think there are some sportswear companies already announced results. Looks like they've already reduced the inventory they need to. They already have the price cut. They're not expecting a sharp rebound, but a gradual improvement. So they already prepare for the challenging market that has happened over the last 2 years or so. So ongoing, I think we are expecting sort of a step from the bottoming out of the market.
In terms of the commodities sort of theme, I think everyone's been talking about, how to kind of position around it right now, because it initially was that, some of the supply constraints were going to actually help some of the miners and the like. But now when you're talking about potential hit to the global economy, we're actually seeing a bit of reversal in some of these sort of equities now. How should I look at the commodity space in particular?
Well, I think it will boils down to how long the disruptions will be, right? I mean, that's what you said. If disruption is going to last for a long time, then we are seeing a much slower economic growth or even recession. And so then it will hit manufacturing activities. But so far, at this moment, we are expecting probably disruption only lasts till early April or end of March. Then the copper and aluminium, these are the two materials we still favor because the supply is still not enough. And plus, these are the two materials very important for EVs, for AI, data center, you name it, renewable energy and all that.
Yeah, and it's interesting as well, just on that EV story. I mean, BYD, for instance, is a stock that's performing well, and we're hearing lots of reports of showrooms around the region that are really busy just on the back of the oil crisis. In terms of havens, though, what do you think then about allocation to bonds, and which part of the curve, I guess, are you also interested in?
Well, at the moment, it's still uncertain. So investment-grade bonds, 5-year maturity would be our favor. Longer term maturity would be susceptible if there is any change in interest rate expectation or even perpetual. So that's an area, remember in 2022, which are the area of the bonds that was under much pressure.
Yeah. Do you think the steepening we've seen in the CGB curve, I mean, after we saw MPC, they were talking about 2% when it comes to inflation targets and the like. Do you think those moves that we've seen are sustainable?
Well, I think you're talking about the China long end curve. I think we will continue to be at sort of 1.8, 1.9% level. I not expect any sort of upsurge from here.
Okay. Eva, thanks very much for joining us. That was Eva Lee there of UBS Global Wealth Management. And coming up, we're going to be taking a look at Asia's rapidly growing ETF space. It's in our new weekly segment, ETF IQ Asia. This is the man they call the godfather of ETFs. That's Reggie Browne joining us soon. More ahead. This is Bloomberg.
This morning, sources have told Bloomberg that President Trump and top Justice Department officials support a new bid to investigate Fed Chair Jay Powell. Last week, a judge rejected subpoenas issued to the central bank, which prompted U.S. Attorney Jeanine Pirro to say she would appeal the decision. The investigation is related to the Fed's $2.5 billion renovation of its headquarters and testimony Powell gave to the Senate. President Trump says he is resetting his planned trip to China, suggesting it could now happen in mid-May. Trump was due to head to China at the end of this month, but decided to delay the trip as he focuses on his war with Iran. His planned meeting with President Xi Jinping will be closely watched for progress on trade and Beijing's reaction to the Middle East conflict.
Taking a look at how markets are faring, solar stocks were actually seeing some pretty good upside gains here. There is a report out from Reuters saying that Tesla is in talks with Chinese firms to make acquisitions of solar equipment. And so we are looking at some of the names that have been mentioned. For instance, the first one, Suzhou Maxwell, is one possible candidate, but Tesla essentially aiming, according to Reuters, to add around 100 gigawatts of solar capacity. Asia miners also in focus this morning. We actually are seeing the materials sub-index amongst one of the biggest laggards in the session so far, and that is being reflected across into some of these names today. Aussie petrol retailers as well to note, because we are getting government measures essentially to support fuel security. There's a lot of question marks around essentially cost of living pressures, given you just had the RBA rate raise, and then off the back of that as well, concerns around access to petrol, given those events ongoing in the Middle East. But we'll have more ahead. This is Bloomberg.
Jensen Huang from NVIDIA said, I think yesterday or the day before, at their global GTC, saying that OpenClaw is equivalent to HTML. I mean, without HTML, there's no website. And he also said OpenClaw is equivalent to the ChatGPT moment. So we think for Tencent to go all in OpenClaw is not just a good thing, it's a great thing.
Jiang from Barclays.
As Barclays earlier reacting to the earnings from China's big tech names, and certainly calling OpenClaw the next sort of ChatGPT or HTML certainly is a bullish sort of signal there. Investors, though, have been showing a sense of disappointment against some of these China tech earnings, to say the least. As we wrap up this week of Tencent and Alibaba, you're seeing the shares for Baba down some 5%. It really has been dragged down by the growth that we're seeing, or the sluggish growth, when it comes to the core e-commerce business amid this weak domestic consumption. The AI sort of headlines have been quite big as well, as Ellie Jiang from Macquarie said. 100 billion in 5 years in terms of annual AI and cloud sales is ambitious at this moment. Did they do enough to tell how they're going to achieve that sort of milestone is certainly going to be a key question here moving forward.
Yeah, and I think another key question as well when it comes to that amount of spending on AI, what sort of pressure does it put on the margins of the business longer term? Because Bloomberg Intelligence is saying that those are going to be limited on that basis. But our senior analysts, Catherine Lim, Robert Lee, are with us this morning. So, Catherine, we can go to you first. I think, lots of question marks really around the e-commerce spending and how much they're needing to defend their market share. But we did just get that overall miss on revenue expectations. Is that coming down to demand and issues around that, or are we looking at execution problems instead, do you think?
Yeah, that's a great question. I kind of think it's actually a function of both. The company have spoken that, yes, it was a very weak fourth quarter, which is the October to December period, December in particular. They've actually seen things picking up. But I do think that, we do have to consider the execution side of it, because, Quinn, the way it is being embedded into, Alibaba's ecosystem, we have yet to actually see that in this set of results. And I think, that is also another big question that markets will have. Did that work? Are we going to see more of it going to come through, in the next set of results? And more importantly, as you've highlighted, what is the impact on the margins? Because we've seen all that Lunar New Year perks that not just Alibaba, but JD.com, Douyin, everyone was just throwing to actually try to drive up agentic commerce use in China. So we'll have to see how that goes.
There's this sort of, you mentioned agentic commerce, Gus. We're still trying to wrap our heads around agentic AI. What does that mean for Alibaba?
Yeah, we're in a very, very early stage of it, and Alibaba clearly has a lead because of the embedded ecosystem that it inherently has itself. Literally, it's a single prompt transaction. that we're talking about, if I can put it in very, very simple terms right now. And that is where the execution, and I think over the course of 2026, we're going to actually see how that actually changes, not just the consumer behavior itself, but also how merchants are actually allocating their advertising, marketing dollars on these platforms. And that will also have an impact on revenues as well as margins.
Rob, let's bring you in. I guess it's an interesting comparison to make as well between Alibaba and what Tencent is doing, but how their AI strategies diverging, do you think, and how is that also being reflected in the way that investors are reacting to the numbers too?
Okay. Well, I think as we know, there's a difference in corporate culture and the way both companies present. Alibaba tends to be far more upbeat. The messaging was much clearer compared to Tencent. But the stock's still down. And because the common factor between both is they're upping their spending in AI. AI is clearly the focus, but where's the return on investment? So we don't know how large that return will be. We don't have a timeline for that. And whilst there's been some commentary in your sort of prelude about rising AI investment depressing their margins, what about the cash flow? Ultimately, everything washes into cash. And if you look at the free cash flow of Alibaba, for the last 3 quarters, cumulatively, it's been negative. Whereas if we had this conversation 2 years ago, before the stock sort of took off, it was seen as a value company, and one of its key strengths is obviously its size, its scale, and its inherent cash generation. So now they are sacrificing significant amount of cash, very expensively in sort of crude terms, investing in CapEx. Interestingly, they didn't give updated CapEx guidance last night, although clearly the CapEx spend will be going up. So whilst the headline's a 100 billion figure in 5 years, yeah, that's great, but what sort of margin will you be generating on that? And also at what potential CapEx cost? Because, for example, if I walked in here and said, look, I've bought a $5 million apartment, great. But, if I didn't tell you I've also got a $5 million mortgage, you're missing that half of the equation. Similarly, there's all this focus on the income statement of revenue, but what about the margin? And it's the cash cost, the CapEx costs are sitting on the cash flow and the balance sheet. People must focus on that because on a net cash basis, all these AI companies in a China context, in cash terms, are losing heavily. They're losing heavy amounts of money on AI at the moment with no, significant visibility on when they generate an ROI, both in income statement terms and, more importantly, cash terms.
So do you think investors are just kind of relying too much on hope that AI can transform these earnings and the outlook for the company?
Well, for the bullish analysts out there for the last year, that's what they've been arguing. Let's be fair to Alibaba. They are the dominant cloud company in China. But if you look at their margins compared to Amazon Web Services, with the numbers they've just printed, they are generating a 9% adjusted EBITA. Amazon Web Services in Q4 did 35%. And that reflects the much more fragmented nature of the China market, the huge pricing pressure, and the low relative returns. And then the other thing I just mentioned is what Alibaba is doing as the leading cloud supplier in China is obviously in line with the government's overall AI plus strategy. They're looking to proliferate AI across the economy, to drive the uptake of AI through agentic AI and other means. That's great, but someone needs to shoulder the cost. And really, Alibaba is subsidizing that rollout. So the winners of this are the Chinese economy. Maybe that will help to boost economic productivity. The consumer is clearly the winner, but Alibaba is subsidizing it. Therefore, the shareholder is the loser, hence the reaction you saw in the markets. And the same applies really, I think, to all the AI names. There's not a commercial return there available to the companies. Which is why the narrative is changing and people are focused much more on returns, which we have no visibility on.
Yeah, so Catherine, I'll bring you back in then on that point around what Rob's saying there. Can Alibaba, do you think, then deliver profitability from the AI story, as you said it? The cloud side is certainly pressured, just given, especially with agentic AI, a lot more token consumption, which is also a cost to the business.
Well, look, Alibaba's narrative on profitability versus, what it is looking to achieve from a market share perspective, whether it is from the AI or digital commerce for that matter, hasn't quite changed. They have always been guiding that for the next 2 to 3 years itself, they're going to be focusing on trying to actually get the market together, cement that presence itself. So I do think that, what is going to happen after this really is, the reality that we may not be able to actually see the profitability or the ROI as Rob has actually highlighted. But we do need to actually see some form of, results of what they are doing in terms of the top line. So again, the e-commerce didn't quite excite, I would say. It missed by nearly 2%. And I am on the lookout for the next quarter to see whether Quinn, as it actually gets embedded into the entire ecosystem, will that be able to actually help revive things a little, because the e-commerce business itself is still an element of which that they can really monetize in the longer term.
Catherine, thank you, and our team at BI that covers Alibaba, Catherine Lim and Robert Lee there, both covering the e-commerce and AI side of things. Coming up, we're exploring Asia's rapidly growing ETF space in our new weekly segment, ETF IQ Asia, the man they call the godfather of ETFs. Joins us next, Reggie Browne. This is Bloomberg. Yeah, change the backgrounds, change the colors now. Second edition of our special weekly segment of ETF IQ Asia. And the war in Iran is certainly fueling demand when it comes to ETFs in the Asia Pacific, with inflows jumping to the highest level in years. Now, that's according to data from Bloomberg Intelligence for early March, with the surge being led by funds in Taiwan and Japan, Belle.
Yeah, let's get more on this now. Bringing our Bloomberg Intelligence senior ETF analyst, that's Rebecca Sin, of course. So, Rebecca, just tell us, ETF flows, of course, they've been shifting since the start of the war in Iran, but what are you seeing so far?
So whenever there's a crisis, we really see investment in 3 phases. The first is panic, the second is recovery, and the third is risk clearing. So we're currently in the panic phase, so a lot of volatility. And in the Asia Pacific, whenever the markets drop historically, ETF flows would point to around 1 billion per week. But we've seen this number triple in March. And so in Japan, 3.5 billion, in Taiwan, 3 billion, and in Hong Kong, 2.5 billion. And so what we've called this is really the chips and dips, because investors are really buying at the dip, but they're buying into the chips names, the likes of semiconductors. And across the flows, we've seen a lot of investments into this. If we look at the flows globally, we've seen the same thing. We're now at record levels for ETFs, and ETFs have almost reached 22 trillion at the peak. And if we look at the best performing ETF, it's a break wave tanker shipping ETF, and this ETF has returned more than 300%.
Wow.
And the reason why is that it tracks, it has the largest cargo ship used to transport oil from the Middle East to Asia and America. So it locked in the prices early on ahead of the war.
Chips and dip, I love it. Makes me hungry. But you've been talking about shipping certainly has been one sector. What other sectors have investors really been attuned to recently?
Of course, energy has been the one that's gotten the most interest, but a lot of the reason is ultimately people are looking for alternatives to oil. And so if we look outside of oil, nuclear has been a big one. And you may not know this, but South Korea powers a third of its energy off nuclear. And so it's one of the largest. And in South Korea, Macquarie has an ETF that tracks nuclear that has returned 125%. Next to that is power grid. China operates the world's largest high voltage direct current network, which is required to transmit hydrogen and wind power. And these ETFs have returned on average 30%. Next to that is then hydrogen. Hydrogen is, of course, the alternative. And across all the hydrogen ETFs, it's returned roughly 30 to 40%. So if we look across the sector, a lot of people are investing into these thematic names. And specifically, Chinese investors are rotating into energy and utility. And if we look back into Hong Kong specifically, last week we had CSOP where she talked about some of the flows they've seen. But the best ETF that has gotten the most inflow is their CSOP 2 times SK Hynix. So we call it the chips and dips because in Asia, we've seen a lot of investors investing into the chip names.
Yep, still a lot of dip buying there. Okay, Rebecca Sin, thank you, our Bloomberg Intelligence senior analyst, trying to kick things off for us. So let's bring in Reggie Browne, principal at market maker GTS Securities. He's sometimes known as Mr. ETF, if you don't know him, for his role in helping to build the industry in its early days. He joins us now from Uruguay. Gosh. Reggie, thank you so much for staying up with us. I don't even know what time it is in Uruguay right now, but thank you. Tell us about, Rebecca kind of set the scene here about, there's a bit of dip buying in the chip space. Shipping energy certainly has been hot. How are investors using ETFs at the moment to ride out this volatility? What's the big winner?
Well, I would agree with Rebecca. I think that there are definitely two buckets of active ETF users. It is the buy the dip, so that would be like Korea and Japan, where assets are growing, but the prices are going down. Just with the action in the marketplace, but it's growing. And then if you look at India and Taiwan, they're losing assets, markets coming down. So it's kind of a bifurcated marketplace. And I think that there's a lot of long players that are looking at value buys that are just piling in where they see opportunity, as clearly being demonstrated in ETFs.
And beyond the energy names, which other sectors or types of ETFs are you looking at here?
Well, looking at broad-based stuff, but clearly, if you look at the gold sector, it feels a little sloppy here based on what's happening. There's been big debate on our desk. One of our senior traders, Ed Yoon, thinks that there's some forced selling there. And so if you look at gold and gold miners, I think that's kind of a hot flash there. That's probably a temporary turnaround, because typically gold and oil have positive correlation, but yet they're breaking apart. And I think there's something there. If you just look at just the China energy sector, Rebecca touched on it earlier, but here in Uruguay, if you look at just the market share of Chinese cars and clean energy, I think that there's something there based on just what I'm seeing here. And so I think that, it's broadening out. The countries that have positive energy exportation, they're the winners, and those who are energy buyers, they're the losers. And I think you're seeing that in ETFs playing out.
How are people hedging right now, Reggie? I mean, as you mentioned, right, it seems like gold is maybe kind of seeing a short-term turnaround, not behaving as the haven that it should be. But is it really time? Are people kind of hedging for inflation? Is it time to kind of build up into real assets? What's sort of the take that you're getting from flows right now?
It feels as though that real assets to play. The earlier energy ETF I should have mentioned was 1618, which is the Topix energy ETF. But real assets, I think there are a lot of investors that are using ETFs to hedge against the move for higher inflation around the world with just the oil move. And it feels as though like that's the current focus point, but it's thematic temporarily until this gets sorted out in the war in Iran.
How do you think then about, I guess, the relative value between the strength that you're seeing in certain commodities, but then also the AI story and the tech story? Because we've actually continued to see, of course, some volatility on the tech side, but in Asia at least, some of these names continuing to move higher.
You know what? If you look at Korea, first of all, the Korean ETF market is just exploding. And I think it's almost surpassing Taiwan. And so that's really the AI chip story right there. And the retail investors who play ETFs out of Korea, there are some smart people there. And we tend to read their flows looking at just what to expect around the globe, following the exchange map. And so I think that the AI chip story and just overall retail players, you can't really bet against them. You got to go with. And so this is the story that we're watching. And then we're also setting our prices based on expectations of, moves throughout the night based on the U.S. where I'm located. And so Korea, I think, is really, moving the marketplace with all its AI and chip building and just, what's happening in that marketplace.
And Reggie, I want to get your take on just overall, the whole industry has really transformed, right? Maybe since your early days, you've had this sort of pioneering sort of role of really kind of developing the ETF industry from its early days. How do you look at it now, given the amount of, I guess, that's the market structure, liquidity of this market? How much has it evolved? And do you think that we still need to do some more structural upgrades in the industry moving forward?
Well, listen, it's exciting. I mean, you have just tokenization that's marching around the world. You have, just new types of ETFs, active managers coming in. And then you have ETFs that are growing in new market centers. In December, I was in Dubai, cross-listing 2 ETFs in Dubai. It's unfortunate what's happening in the region. And then those ETFs were cross-listed across 7 exchanges. And so if you look at the growth of ETFs, the field is growing. And I think that, market structure, exchange rules, particularly in these new countries, need to evolve to around ETFs to grow. Here in Uruguay, you can't move offshore. So you want to use an ETF, you have to put in a structured product. And if you look at the average fee here in this region, it's like 2.5% for a retail player, but yet ETFs are 50 basis points. And so the marketplace, I think, needs to allow for competition. And then market makers like myself need to move into these regions to bring liquidity. So there's still some growth to occur. And more of my competitors are recognizing what I see and the opportunity to grow.
And what type of products then? It seems like, of course, you've got the plain vanilla ETFs that track a particular asset class, but there's levered, there's inverse, there's a lot of different types of ETFs out there. What are you seeing as the biggest potential?
Well, if you look at South Korea, the levered ETFs is one of their favorites to utilize and deploy capital. But it really comes down to I think, active managers and then tokenization of ETFs. And so it comes down to themes. And so whatever the flavor of the month is, you'll see all the action because, investors will pile in. But long core, I think, is really around AI, chips, and then also renewable energy around EV vehicles. I mean, it feels like that's the tail that's going to wag the dog. But if you look at Korea, with just all of their growth around chips and their leadership, you got to follow that market too. So I think you'll see more adoption and more ETFs come out where themes allow retail players to grow. But the real story is around active managers launching ETFs away from mutual funds globally.
Reggie, thanks very much for joining us. That was Reggie Browne there, principal at GTS Securities. And you can tune in to ETF IQ Asia. That's every Friday here on The China Show. We're bringing you more analysis and conversations with top market players and newsmakers. More ahead. This is Bloomberg.
Right, it's Friday. We've got to look ahead to next week, and certainly it could be pretty busy. On Sunday, there is that China Development Forum to watch out for. Sinopec earnings also come out on Sunday as well. A Milk and Global Investor Symposium that happens here in Hong Kong on your Monday morning. We'll have a team there on the ground. And on Thursday, the G7 foreign ministers meet also in France as well. I'm guessing they'll be talking a little bit more about the Iran situation. But yeah, I mean, if you're looking for a little pick-me-up against all this headlines and whatnot, let's talk about BTS, right? It's going to be a treat this weekend. If you've been missing them for the last 4 years, they're making a comeback, right? And it's going to be a massive, massive event.
This is huge, actually, yeah. when you take a look at the numbers. So there's a freak show that's going to be a free show, rather, that's taking place tomorrow in Seoul. Do you know how many fans are expected there?
260,000.
That is wild.
At the Gwanghwamun Square near the palace. Yeah, I mean, it's crazy, right? They're dropping a new album. They're going to be live streaming with Netflix. So if you can't fly there, like those 260,000 fans, you can still watch it streaming. But yes, I mean, if you talk about the amount of flights and really the meals, the hotel bookings, everyone trying to get this new album as well. Arirang. It drops the day before, of course, their performance. So yeah,
just to
it could
highlight,
rival the Eras tour. That's
yes,
the big headline.
But even surpass it, because you're talking about maybe from this free concert alone, $177 million of economic impact. A single stop, or Taylor Swift's average per concert bounce, was around 50 to 70 million per US stop.
It's nuts.
This could be $177 million in economic impact.
What happens when you take a 4-year break, right? Look at Adele. Every time she comes up with an album, she does very well. All right, that's it for us on The China Show. Have a great weekend.